Alright, so, hello. What is the fixed range volume profile? What is this tool right here and how can this help us with our trading? Right, starting off, this is called the value area high. This here is a value area low and this is a point of control, the POC. Now, this point of control, the red line, is where the most volume has been traded in this session or this time period. The value area high is the top part and this is the bottom part of 70% of the average volume. Now, what are we even trading? This strategy is called liquidity, supply and demand, and to recap, basically we look for this kind of structure which you can see in this trade. We look for a breakout, which up here is the supply zone or order block. We look for a breakout which then creates some liquidity here. So these highs here don't come back to the zone. These highs stay below it and create this liquidity. Then we wait for price to retrace back to the zone and then we enter, the wicks in and hopefully get a nice high RR. As you can see here, that's what I exactly did. Price creates liquidity, nice structure. I enter when it wicks in and closes bearish, so around here. And yeah, that is a valid setup and that is what we are trading. This here is a very good example of one of our setups. Goes down, creates that liquidity all under there. Obviously fakes out from the liquidity, comes down quickly, wicks in, we enter and ride the wave of the institutions. We ride the wave of the orders that are being brought at this demand zone. Alright, here's a great setup here, probably A plus in my opinion, because we are in a bearish market, a bearish trend. Supply zone right there, accuracy zone, we get rid of the wick because it's bigger than that candle. Liquidity is formed twice here. Price retraces really nicely back to our zone, wicks in, get the perfect entry. I mean, look at that, you could have got what 1 to 10 just by aiming at that high. It's crazy. This strategy is really good. But like, how can we understand how price is actually going to work in the strategy without just looking at the structure? This tool provides a confidence for us to make sure we understand where we are entering and how the market is going to react from our position. The fixed range volume profile is basically a histogram that shows you all the volume that was traded over our range, which is, as we do it, it'll be from the start of the supply zone to the entry, which is here. So we drag it over those points. And this will form us this weird kind of, area. I have removed the HVN and LVN. Right now with this line here is the POC, the area with the highest amount of volume. Now, we're looking at the setup. What can we see? You can see, as for now, there is a lot of volume concentrated around the top area of this setup. This area here, where it will wick into the zone, has not a lot of volume at all. However, above that area, this area here, there are a large amount of orders at these price levels. Right now, we're in a bullish market, a bullish trend. Think of this. All these traders, institutions, retailers, it doesn't really matter. They've all placed lots of trades like this, creating lots of volume. There may be some sells, but we are in a bullish trend, so we can presume they are mostly buys. There are hundreds of, maybe even thousands of these trades, as you can see by the large amount of volume. How does this help with our setup? We have a high volume node here and a low volume node here. POC is high on our setup. This means all the trades are above our entry. If we're in a bull market, our entry is a cheap price. It is below the average price paid for all these entries. The average price is up here and our entry is down here. That adds one confluence. As our entry is below the average price, investors will see that as cheap and purchase it, which should add some bullish bias to our trade. Secondly, there is a low volume node here. What does that mean? There's not a lot of orders here. If price comes down to this area of low volume, there's going to be no institutions or, traders, mainly institutions, who are going to defend their prices. If an institution has placed a buy up here, if price goes down, they'll want to lift it back up as they will be down a lot of money. They are trading with pensioners, pension funds, all sorts of money that they have to keep, they have to stay safe. They will try and push the price back up if price drops below here. Now, when price is down here, there's no volume, there's no sellers or buyers. If price arrives at our zone and there's a low volume node around our zone, as you can see here, that means that price is more likely to move quickly back up to this high volume area. This is because there are less positions defending this price. There are less institutions, traders, who will defend their price and make sure if it goes up, pull it back down. They haven't simply got the positions there. That is a really good confluence. If there is a low volume node in front of your zone, stretching up close to TP, that is really good because there's less resistance. Price is going to be more inclined to push up quickly without resistance, without breaking through all these positions. How do we know there's institutions? How do we know there's actually traders here? Volume. Institutions cannot trade all at once. They have to trade separately in lots of different trades because of this thing called liquidity. They have a lot of money to put in. If they put the money in all in one trade, it'll go through all the orders at that price, move up, go for all the orders at that price, move up, move up, move up, and by the time it's done, they would have entered at all these different prices going up that they would have entered at a loss. Because at the start, the price has gone up for their initial trade, they would be down. So what did they do? Wait for liquidity. They have found their liquidity here. For some reason, as you can see, there's a lot of wicks stopping out all these buyers. They wick them out, absorb the sales, and purchase. Price has suddenly dropped down below this area of trading. All these institutions have positions here. You can see there is a lot of volume. If price drops below, they are down lots of money. So here's where the second confluence comes in. Institutions hate losing money. They hate it. They don't like losing money. They will try and drive the price back up, back to the original price. So how can we put this information together? If price enters an order block or demand zone, as you already know, this is an area where investors missed out on, so they want to get it at a cheap price. This is a cheap price, as the POC is all the way up here. This is the average price here. This is a cheap price below. So this is a cheap price to enter. And B, this is a price where investors have lost money, because as you can see, this is below the average price. This is down below their positions. So A, they want to enter as this a cheap price, and B, they want to enter to back up and defend their positions. What does this mean for us? More bullish chances. There is more bullish chances of this trade hitting if this POC is high and there's a lot of volume up here. This trade is very good as there's a low volume node before our entry, all the way here, which means price will move quickly up, and there is a high volume node with a POC fairly high, which means that price is cheap and investors are losing out, so they are more inclined to buy. Here is another example of a good volume profile relating to our trade. We can see liquidity created, wicks down into it, and with the volume profile, there is low volume where it wicks in and high volume above the entry. This price here is cheaper than this price up here, which influences entering. This price here is also lower than the average volume traded around here, meaning positions are down in money. They want to back up, defend their positions, they may buy more. This adds confluence to our trades. This trade here is another great example of how we can use this tool to help us enter trades. High volume here, above our entry. This here is where all the institutions are entering. You can see the accumulation here with this price action. A lot of wicks, a lot of entering, a lot of building up positions. And you can see right there, because of the volume, there's high volume traded. Down here, not a lot of volume. Around our entry especially, there's not really a lot of volume compared to up here. This really assists us, because as we know, this will mean price will move quickly. Price will move quickly from our volume. Now, we have lots of trading up here. Our entry, price is cheap. This incentivizes traders to enter on this order block, which is already a price where investors missed out on. If it's cheap, it makes it even better. Why would they miss out a cheap price, which is cheaper compared to their positions as well? This adds confluence to our trades. This is high. This acts like a magnet. It pushes it back up. And as you can see, price moves really quickly, smashing past it, literally. It's really effective. Here's another example of a valid setup with a good volume profile. Right, our entry is here, but the volume is all the way up here, is higher than the entry. This is a magnet pushing up towards these positions. Low volume nodes here, here, and also above there. The key thing really, in my opinion, is looking at the POC and where that is. I use that as a main gauge to judge whether a trade is good enough or not. As you can see here, the POC is higher than the entry. We enter here. You can see that the POC is a high price compared to our entry. This means this area is cheap. This entry is cheap. It increases the likelihood of it winning. This here is a situation when we can use the fixed range volume profile to determine if it's worth entering a trade. Now, if I delete this for a second, you will easily see that this is a pretty valid setup for our strategy. Got liquidity right here along this line. Comes down pretty quickly, wicks into zone. Bit of odd action there with that candle, but it does close bullish. So this is a possible entry. What happens if you draw out the volume profile? Immediately you can see, apart from the other setups, this POC is very low. It is literally on the candle that we are gonna potentially enter on. That immediately signals to me, hold on, wait, what's going on? I can see there's a lot of volume up here with that quick reversal. That indicates to me that there's a bit of selling pressure on this setup, as huge bullish momentum just cancelled out like that with a couple candles and a couple wicks. Now, coming to the POC, it is super close to our entry, really close. I mean, it is the candle, it is touching our candle that we would enter on. On the other setups, it's above, this one is on. We can already tell there's high interest in this price. There's a lot of volume here, a lot of trading happening. And I can also tell there's a lot of resistance. Price cannot break through this POC. There's what, 1, 2, 3, 4, 5, 6, 7 wicks that just can't get broken through. Now what am I thinking? I don't want to enter on this trade because I have a feeling I may get stopped out because it is turning potentially bearish. Without this, what would you see? This would be at the entry point because you wouldn't see the further price action. You can see it already with these 3 candles. You can see it reacting off the POC. So immediately that signals to me, alright, I don't really want to enter. And look at this. Rejection, 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 rejection. And then yeah, you lose the trade, you lose the trade.